Mortgage interest rates have finally peaked, so with that, we can all breathe a sigh of relief. But that doesn't mean we're completely out of the woods, as home sales fell to a 13-year low in October as prices continued to rise, and pending home sales are sitting at the lowest level since the National Association of Realtors began tracking back in 2001. And on top of that, we have a divided Fed, with Fed members like Bowman expecting another rate hike, while on the other side, we have Fed member Waller expressing confidence that the policy is in the right place in order to bring inflation down. And with that statement alone, we saw a huge drop in mortgage rates, which is added to the drop that we've seen over the last 4 weeks, with mortgage rates now dropping for 5 straight weeks, coming off the highs that we saw near 8% to settling where we are today, somewhere around 7%. And because of that, we've seen mortgage demand rise to the highest level we've seen in 6 weeks, along with news that home prices hit a record high in September, even as mortgage rates continued to climb. But if the past tells us anything, we know that we're not completely out of the woods, because the slightest good news for the economy could create additional volatility and potentially push rates back higher. But with that said, I do believe that the peak is in and that mortgage rates will likely continue to grind lower, which more or less supports what National Association of Realtors Lawrence Yun is saying when he's saying home buyers can expect to see mortgage rates somewhere in the 6% range next year, along with Mark Zandi, Moody's chief economist, expecting mortgage rates to settle somewhere between 5.5% and 6%. So what exactly has caused this sudden drop in rates? Well, that's exactly what we're going to get into right after you hit that thumbs up if you find any value in my videos at all. And also do me a favor and subscribe to the channel to stay updated on everything real estate related. While we have news that the US GDP is growing stronger than expected, sitting at 5.2% for the third quarter, but on the flip side, we now have the Atlanta Fed GDP now showing that growth in the fourth quarter is likely to slow somewhere between 0.9 and 2.1%, which is significantly lower than the normal trend of 3%. In addition to that, we have the Fed's favorite gauge, the PCE, showing that inflation is continuing to moderate, coming in at 3.5% from a year ago. And while both of these measures are higher than we likely want them to be, they are showing that the economy is continuing to slow, which is exactly what the Fed wants to see and something that they mentioned in their recent minutes, believing that there's still some tightening in the economy that has yet to flow through the pipeline, believing that the growth of the economy is likely to continue to slow going forward. And part of that's because the recent rise that we've seen in long-term yields is actually helping tighten the economy without having to do additional rate hikes, which is more or less why they paused in the last meeting and exactly why the consensus believes that the rate hikes are likely over. In fact, if you look at this chart here, you can see that the probability of the Fed hiking rates in the next 2 meetings is more or less non-existent. In fact, we now have nearly a 45% probability of the Fed starting cuts as early as March of 2024. But as we've discussed in other videos, there's no way the Fed is going to let the market actually believe that, because otherwise the market would front run those rate cuts. Because if businesses and people out there believed that the Fed was actually going to cut as early as March, they would start borrowing money again. The businesses would start spending money again. And in turn, that could create additional inflation in the economy, which is exactly what the Fed's trying to avoid. But here's the thing. The Fed is actually somewhat divided when it comes to their thoughts on the economy. Now, is this planned out and something that they talk about in meetings? I don't think so, but you do have both hawkish members and dovish members of the Fed. As you can see by this chart here, you can actually see where the Fed members fall on this chart with regards to being dovish or hawkish or somewhere in the middle. And those people in the middle are the full-time voting members. So those members, regardless of their comments, tend to go with whatever Powell thinks should happen in the economy. But with that said, it's quite funny to look at this chart and then read the comments that they're saying out there, as the hawkish members are hawkish and the dovish members are actually really dovish. For example, when we look at the comment from Barkin, who is one of the more hawkish members on the Fed, saying that he believes inflation is being stubborn and makes a cause for keeping rates higher for longer. Then you have Fed members like Bostic, who is on the other side, a more dovish member, saying that he's more confident in the soft landing forecast, more or less saying that he believes that what they've already done is enough to bring inflation down to a point where we're not going to have this really hard landing in the economy, some major recession. But either way, the latest Fed minutes show somewhat of a unity between Fed members on a cautious approach to continue hiking rates, which is a good thing for the economy, because that means that the Fed is somewhat in this stance that they're just going to pause and wait to see what happens in the economy, wait to see what they've already done with rate hikes and see how that actually impacts things like employment, how it continues to impact inflation, and all the while giving no indication that any rate hikes are in the future. So when it comes to the topic of rate cuts, what would it take for the Fed to actually start cutting rates in 2024? Well, before we dive into that, I want to take a minute and ask you that question. What do you think it would take for the Fed to start cutting rates? Is that something that's probably on the agenda already, or do things need to get a lot worse in order for the Fed to offer some sort of quantitative easing and start reducing rates? Do me a favor and let me know in the comments below. Well, if the Fed does meet market expectations and start cutting rates in, say, March of 2024, well, it will likely be because of rising employment and a sharply slowing economy. In fact, there's something important to note. Interest rate cuts don't actually happen during good times. Typically, the only time the Fed will start cutting rates is when they're trying to stimulate the economy, try to provide some growth for the economy. And at the moment, I'm not sure we're quite there yet. In fact, I think March of 2024 is a bit early for the Fed to start considering cutting rates. While I do believe 2024 is going to offer rate cuts, I'm not sure the economy is going to show enough slowing between now and then for the Fed to completely take their foot off the gas pedal and put it on the brakes. And that's exactly why I don't necessarily believe that we're completely out of the woods. And while I do see the government continuing to spend more money than they're bringing in, essentially taking the national deficit even higher, I also believe that the Fed has gone too far in this cycle, taking rates higher than they probably should be because they're paying too much attention to what's actually happening now versus the impact that it's likely to have in a couple of months or even further down the road, which is exactly what they did on the flip side when they took rates too low for too long. While it benefited a lot of us out there that were buying homes, that own homes, it also created major issues affecting housing affordability because we saw prices rise to the highest levels that we've ever seen. And since then, we've seen mortgage rates more than double, which is added to the housing affordability issue, which is exactly why 35% of Americans are hoping that the market will crash in 2024 so that they can buy a home. While hope is a good thing, maybe the best of things, and no good thing ever dies, it's not the right approach when it comes to buying a house. Instead of hoping in this market, you need to focus on the things that you can control. And I think one of the most important things to focus on right now is making sure you have a longer term time horizon if you plan on buying a house. And that's because people have really, really short memories. What they're doing is they're looking back and seeing how much homes have appreciated over the last couple of years and hoping that if they buy a house that they're going to see similar appreciation and that they're going to be able to take that starter home and likely buy a bigger home and parlay it and continue on. And the reality is that's not likely to happen because of how much appreciation we saw in that short period of time. Instead, you should focus on trying to find the right house, a house that's going to serve you somewhere between the next 5 and 10 years, depending on what happens in your life. That way, if home prices do move sideways or even down slightly, you're not in a position where you have to worry about it because you have that longer term time horizon. And while a lot of people out there are wondering whether or not they should buy a home in 2024 or wait, depending on what happens to prices and rates and all these things, I would tell you there's a really good chance that you see interest rates continue to grind lower. Like Mark Zandi said, I think rates could settle somewhere between 5.5% and 6%. And we're currently sitting somewhere around 7%. And every 1% drop we see in mortgage rates, that allows 5 million more people to potentially buy a home. Now, all 5 million of those people aren't going to go out and buy a home, but it does add additional competition. And as we point out week over week, inventory is still really, really low. So with more demand and less supply, you're likely going to see a market very, very similar to 2023, which means home prices are going to grind a little bit higher. Nothing major out there. I would say you're probably going to see somewhere between 3 and 5% appreciation in 2024. So the idea of waiting for prices to come down, for rates to come down, for everything to align to make the perfect scenario, I don't really think that's realistic. Now, that doesn't mean you need to rush out and buy a house, but I also think you need to pay attention to the data and see what the data supports. Either way, I think you've seen the peak in interest rates, but there are some additional things out there that could affect mortgage rates and the direction of them. And if you want to know my thoughts on that, do me a favor and check out this video here.